Good evening, friends. This is Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting. As we speak, Treasury Consulting is a multi-asset and multinational hedge fund. By multi-asset, I mean we continue to take positions in gold, silver, platinum, oil-related spreads, agriculture, contract for differences, exchange traded derivatives, and many more asset classes. God willing, we would be adding more asset classes in the near term. By multinational, I mean we actively cover positions in United States, European Union, and Asia Pacific region. But like I stated many times, and I would continue to repeat all the times, that we are a proprietary hedge fund. By proprietary, I mean to say no third party, I repeat, no third party can invest capital in our funds. Before I initiate the video, I would like to let you know that our aviation desk, which covers services to the aviation companies, is on. The first video regarding the aviation sector is live on the YouTube channel, and eventually we would be adding more videos covering aviation sector on our YouTube channel. Guys, you know that I worked as a corporate treasurer for American companies. And I strongly believe that three things are interrelated with each other. Whether somebody agree to it, whether somebody do not agree to it, that is their problem. Number one is the finance. Finance is completely integrated with the law. That's an unfortunate fact that majority of the people do not have the knowledge of the law. Majority of the people do not want to have a knowledge of the law. And there is a tendency which is being created worldwide that learning law is like learning a rocket science, And today's video is not specific to any country. Rather, today's video is about a global phenomena which I would like to talk. And in this video, I would be covering the linking of contracts with the law and specifically talking financial contracts. Before I move further, financial contracts are of two types. Broadly, number one is the prop contracts. Prop contracts are those contracts which are executed between two counterparties, like law using a term called plaintiff and defendant. But in financial contracting, we do not use a word plaintiff. We use a word called counterparties. So prop contracts are those contracts where counterparty execute a contract between each other. It could be forward contract, it could be option contract, it could be swap contract, it could be non-deliverable forward, or it could be your repo agreement, reverse repo agreement, MLSA, and we can have 100 types of contracts. There are a second broad category is the standard contracts. Standard contracts are those contracts which are given by the bodies who are known across the globe, like ISDA, International Swap and Derivative Association, ISDA. If you do a foreign exchange trading with a client, say JP Morgan, probably Goldman Sachs, Citi, Credit Suisse, or maybe any other, then some part of the contract would be prop, which is the standard terminology which is created by the legal department of the JP Morgan, while majority of the part of the contract is known as the standard contracting, which they have taken from ISDA and the respective bodies. But there is a catch. The catch is that the proportion. It could be 10 is to 90, it could be 20 is to 80, could be 50 is to 50, or it could be 80 is to 20, which means 80% of the contract is proprietary, while 20% of the contract is standard. But majority of the people, I repeat, majority of the people of the globe are having almost zero understanding. I repeat, almost zero understanding to differentiate between a prop contract from a standard contract. And unfortunately, when it comes to one thing which I would be speaking today, which is called covenant. Covenant means condition. If I speak in terms of legal language, it means indictment. To prohibiting you not to do this, indict you. Today I would be serving you three important type of covenants which we are having in the contracting. Whether you are having a prop contract or you are having a standard contract, these covenants or indictments are there. The biggest question which we need to evaluate, the biggest question which we need to answer is that whether these indictment or covenants are going in your favor or it would be impossible for you to handle them. That's the biggest point which we need to answer. But unfortunately, majority of the people, I repeat, majority of the people sign the contract just like they are signing a normal piece of paper. I personally saw in my life as a corporate treasurer that the companies are signing contract just like they hardly bother about this. But when this contract backfire, when the banks put the charges against you or they will put you in the court of law, then you understand the potential damages you have because of the contract. Even American banks cannot run away from that. So guys, to conclude this part, we first need to understand that contracts are broadly categorized into two parts. Now, by contracts means legal contracts, no verbal contracts, okay? Which is prop contracts. Prop contracts are those contracts where the definition of a contract is designed by that financial institution. And it varies from one financial institution to second financial institution. And you cannot charge that financial institution because the definition is varying. This is completely incorrect and not possible in the court of law. Second contract is the standard contract whereby what you are doing, you are basically taking the contracts established by the standard corporations like ISDA, GMLSA, and variety of that. Few of the standard organizations are prominent, few of the standard organizations are not prominent. So please take a note of that. When you having a contract with a bank, they would impose something which is known as covenant. Covenant is nothing but a restriction or indictment. In legal parlance, we call this indictment. It prohibits a company not to cross a limit. It could be a ratio, it could be an absolute number, it could be the submission of balance sheet at an appropriate point of time. It could be some other formula which is very specific. The bank wants the corporate to compute. Like when I was in EXL did the acquisition of OPI, Outsourced Partners International. It was $91 million deal at that point of time. Although as a treasurer, I was completely against that deal. But anyways, management went with that. That is a separate problem. But after the OPI deal, we got an Excel file. And in this Excel file, there were some formulas which were interlinked by the bank, which is called KPA. In short, KPA stands for Key Performance in KPI, Key Performance Indicators. And what we supposed to do on a quarterly basis, we supposed to fill our financial information, quarterly financial information in this Excel file. And then the formula would automatically get linked and we have to share this with the bank. Although I was having interpretation issue with the formula, and I remember at one given point of time, I changed the formula of the bank also. But bank never replied back to me because bank understood that the formula they were serving was incorrect. Anyways, negative covenants are of three types. Number one, it could be prohibitory in nature. By prohibit, it means knockout, which means if you cross this, you are gone. Example, you got a funding from a bank, say $200 million, assuming, and the negative covenant is that if your PAT means profit after tax, bottom line in our parlance, if your PAT came down below 150 crores, assuming, we will wind up the contract, which means you have to return the money immediately if your PAT reduced below 150 crores. Because banks feel that if the organization PAT is reduced below 50 crores, it means the organization is losing. This is bank thinking. This is called prohibitory interdict. Second is called restitutory interdict, which means that you have to restitute. Restitute means you have to bring back to the original, which means it will say if your PAT falls to 150, we will give you 3 quarters to come back to 250 levels. If in the next 3 quarters, you would be able to bring this to 350 crores, we are with you, else we are going. Restitutory, you have to restitute this. Third is called exhibitory. The easiest, I would say. Exhibitory means you have to exhibit. So in this, if the PAT falls to 150, assuming, you have to exhibit. You have to tell to the bank that for what reasons the PAT fall to 150, because it generally used to be 350. If your economic and the financial reasoning you are giving to bank on an email, of course email, not oral, and bank is in sync with this knowledge, bank feels that your reasoning is absolutely correct, then banks will say you, okay guys, you go ahead. We really have no problem in this. So remember, the interdicts are of 3 types. Number 1, it could be prohibitory. Number 2, it could be restitutory. Number 2, it could be exhibitory. Unfortunately, majority of the investors in the world, even many corporations, failed to categorize which kind of covenant they are dealing. Because guys, remember, if you are dealing with a negative covenant, and if this negative covenant is prohibitory in nature, it means you are playing with fire. Simple. It simply means that. And if you are not showing your discomfort, your approval, your unpleasant attitude to the bank, then I'm telling you, bank would take this as granted and bank would put another prohibitory type negative covenants in the contract. And the beauty is majority of the corporation who are signing the banks, they feel they have a tendency that, if we discuss this with the bank will feel offended, bank will feel negative, they will give negative feedback towards us, and they will take their money. This is the general trend we are having in the banking industry. Henceforth, most of the people will dare to discuss this. And result, God forbid, when the time came, when the actually invocation in legal parlance, when the actual invocation of this, interdict happens, then bank will simply screw you out. Simply, they will screw you in such a way that you will not be able to even dream that the bank did with you. The reason being, you not interacted with the bank at right point of time. Since you not interacted with the bank at right point of time, you tend to lose the game. Please do take a note of that. But the smart companies who have good legal professionals, companies who have sound legal professionals, of course, less companies, because good and sound legal professionals are costly. They are not free, no complimentary. They charge good, they charge in dollar terms. And generally, companies can't afford that, or companies are very much reluctant in terms of that. The good legal professionals play a trump card, which is called injunction. Injunction means that you are taking a kind of stay on a relevant order by the court. This court could be of any country of the globe, although different countries of the globe have their respective injunctions law. Like English system have their own injunction law, American system have their own injunction law, Indian system have their own injunction law, Switzerland or European system have their own injunction law. Some injunction laws are good, some are little restrictive, some are poor. It depends upon country to country. Amendments continue to happen on a frequent basis to make the life simpler. It would continue to happen. But having said that, the good and sound legal professionals take injunctions in the contract. Now, what is that? When you have a negative covenant and you feel that the company is having no firepower to interact with the bank, you have no firepower to interact with the bank, your capacity to interact with the bank is poor, then what you do, your legal expert will initiate an injunction in the contract. And what is that injunction in writing? Now, when I say injunction, I mean affirmative. Remember, guys, no need to mention it is affirmative. Affirmative means that both the counterparties, corporate and bank, are signing on this contract, which means the parties are allowing in writing that if this negative covenant invokes, then the second party, generally a corporate, having a legal right to take an injunction from the court. I repeat this, having a legal right to take injunction doesn't mean you get injunction. But you can go to court, you put your viewpoint before the court, you explain your viewpoint before the court, you explain your versions before the court. Of course, it has to be, in a legal way, it has to be very, very truly authentic, should not be fake, should not be frivolous. You have to mention this appropriately. And then if the court feels, I repeat, if the court feels that contract also talking about injunction and you are also looking for injunction and the grounds which you are putting, these grounds are really serious grounds, then the court will grant you injunction. Of course, there are variety of injunctions which we are having. there are variety of injunctions which we are having. And remember that when you are signing a contract, especially the banking contract, a financial contract, I'm not talking about the other kind of contracts, I'm focusing on the banking contract, then it would be better, it would always be better, you have a complete affirmative, I repeat, affirmative clause as far as the injunctions are concerned. Please take a note of that. This would ease your life. Like I said, different countries of the globe have their respective laws as far as the injunction is concerned. And you know me that I love reading the books, I love interpreting the things, and I love interpreting in such a way that how can we link this with the financial contracts. In this regard, I am reading a book called Law of Injunctions. It's a book covering law of injunctions, and I'm reading this thoroughly, page by page. I know that it would be taking some time for me to study this whole book. When I went through this whole book, I got something which I have not been able to digest. It's saying that if a contract through affirmative inform, which means that the contract is affirmative, it is signed by both the parties, it is a legal binding contract, which means you cannot run away from your duties. That is why it is an affirmative contract. And courts also stress on the fact that contract should be affirmative. Having said that, before signing the contract, both the parties should read the contract thoroughly and in detail. It's saying that if a contract through affirmative inform is negative in substance, which means the negative covenant, an injunction may issue. In the absence of a negative covenant, an affirmative contract will not generally be indirectly enforced by an injunction, forbidding an act contrary to the contract, which means that suppose the contract is saying that if the PAT, profit after tax, fell below 150, the contract will wind up. And suppose bank is not keeping that. It means that this contract is not, though affirmative, which means it's a legal binding contract, but having no negative covenant. It means due to some economic reasons, even if the PAT fell below 150 or even 120 or even lesser than that, even 100, the bank will not initiate any action. So it is affirmative but having no negative covenant, which means in this case no injunction can be taken. Common sense, no injunction can be taken. But what would if the bank say that you are having a contract with the bank, and in this you are saying that if the PAT fell below 150, I repeat, if the PAT fell below 150, in this eventuality, the company will pay 20 crores as a fine. And suppose today we have depressions, Google cutting job, Amazon cutting job, Facebook cutting job, Apple is freeze, Cisco cutting job, now Intel news is coming in the public, Seagate, you name the company who is not cutting the job. HP cutting 6,000 jobs, Credit Suisse cutting jobs, Goldman, JP, everyone cutting jobs. And due to this scenario, your business will fall. Common sense. You can't run away from that. If there is a boom, it means the boom for the whole world. If there is a recession, it means it is for the whole world. You cannot run away from that. In this eventuality, your profits fell, PAT, bottom line, fell below 150, and you gave your reasoning to the bank that this is the reason because of which the profits fell below 150. And banks discredited these reasons. They are saying, I'm not interested in these reasons, I'm going to discredit it. Then what you do? You will go to court and you will have an injunction. I repeat, you will go to court and you will have an injunction. And this is what it is saying, that a negative covenant will not be enforced if unreasonable and oppressive. A negative covenant, though negative in form, will not be enforced if it is affirmative in substance. I repeat, a negative covenant, though negative in form, will not be enforced if it is affirmative in substance. Please take a note of that. This is the reason I am again and again stressing that contracting is a very, very important thing as far as the financial deals are concerned. When you interact with banks, interdealer brokers, banks, financial institutions, hedge funds, private equity players, venture capitalist fund, they're contracting covering almost everything. Almost. But people are either in a hurry, they have no knowledge, their team size is poor, their knowledge level is poor, they are in a desperate situation. What they do, they sign the contract. And when they sign the contract, it's an invitation to the mess. Because if a negative covenant invokes, then you cannot run away. But having said that, you can run away. Provided you have a genuine reason behind this. And what the hell is genuine reason? Genuine reason, when you have a negative covenant, please note, do not have prohibitive negative covenants, have explanatory negative covenants. Which means you have a right to explain your position to the bank. But for that, we need knowledge. And the smart people, I repeat, smart people, apart from the exhibitory interdicts, what they do, they add one more thing which is called injunction. And when you have affirmative injunction, I repeat, when you have affirmative injunction in this eventuality, you are bound to win the game. But I once again repeat, affirmative interdict or affirmative injunction doesn't mean court will approve this. Court will see the veracity, the legality, the technicality, the substance, and many more things, and of course the respective laws from country to country before approving this. Please take a note of that. This is Rahul Magan from Proprietary Consulting Group. You knew my personal number, +91 9899242978. In case you wish to have more information, you can visit our fixed income platform, www.fixedincome.global. Let me repeat, www.fixedincome.global. Thank you very much, guys. Have a great time ahead.